Chapter 2, Training of Representatives, 19 questions. We start with the Securities Act of 1933. The Act of 1933 is commonly known as the Paper Act. You might even see this act referred to as the Act of Full Disclosure or the Prospectus Act. Paper Act, Act of Full Disclosure, or Prospectus Act. Now, this act requires new issues to be registered. This act requires full and fair disclosure of all material facts. Now, where will these material facts be disclosed? The disclosure document is the prospectus. Now, I want to be careful here. Do all facts about the new issue, do all facts about the issuer have to be disclosed? No, only those facts that are material have to be disclosed. Now, what's a material fact? A material fact is any fact about the issue or issuer that would influence an investor's decision to invest or not. Do you think the type of product that's being offered would affect an investor's decision to invest or not? Sure. How about the educational background of the CEO? Sure. How about the phone number? No. No, that really has nothing to do with investment decisions. So it is the full and fair disclosure of all material facts. Now, the registration statement is filed with the SEC. This registration is now going to enter into what's known as a cooling off period. Bullet point number 3, cooling off period. The minimum cooling off period is 20 days. Now, don't worry whether that's calendar or business, not on the test, 20 days. During this cooling off period, what could be sent to potential investors? The document that would be sent to potential investors would be the preliminary prospectus, also known as a red herring. Now, it's known as a red herring because the prospectus is printed in red ink. No other communications would be allowed. No other communications would be allowed. During the cooling off period, what could we accept from potential investors? Indications of interest only. No money, no orders. Now, the indication of interest is non-binding on any party. So let's say that I am an underwriter selling the new issue. I call you up. Are you interested? You tell me yes, you are. So you've given me an indication of interest. I send to you a red herring. The new issue is now available, can be sold. I call you up. You tell me you're no longer interested. Is that okay? Sure, because your indication of interest was non-binding on you. It was also non-binding on me, which means that the new issue could be oversold, so I don't have enough shares to fill all of the indications of interest that I received, so I don't call you back. Now, no orders, no money, no offers during the cooling off period. Only can accept indications of interest. Now we're going to talk about the Securities Exchange Act of 1934, commonly known as the People Act. Now, the Act of 1934 created the Securities and Exchange Commission, the SEC. Now, the SEC is the main governing body of the securities industry. Remember when we talked in Chapter 1 about an SRO such as FINRA? We mentioned that the SRO is not a governmental agency. The SEC is a governmental agency. Act of 1934 requires registration of secondary markets. So the New York Stock Exchange has to register with the SEC. Broker-dealers have to register with the SEC, and representatives have to register with the SEC. So the Act of 1933 was the Paper Act, requiring new issues to register. The Act of 1934 requires people to register: secondary markets, broker-dealers, and representatives. We continue with the Act of 1934. Act of 34 established net capital requirements for a broker-dealer. Now, folks, you're never going to be asked to calculate net capital. You are going to need to know what the minimum net capital is for different types of broker-dealers, and we're going to talk about that in Chapter 5. Act of 1934 also established Reg T. Now, Reg T is regulated by the Federal Reserve. Reg T does several things. One thing Reg T does is it limits the amount that a broker-dealer can loan when a customer is buying stock with borrowed money. Reg T says that if a customer is going to buy securities using borrowed money, the trade must occur in a margin account. Reg T says that new issues are not marginable for 30 days. So if you buy a new issue, you must pay for that trade in full. After 30 days, then those securities would become marginable. You could borrow using those securities as collateral. Now let's explore the limited amount that could be loaned if a customer buys securities using borrowed money. Reg T says that a customer must deposit a certain amount of the purchase price, thereby limiting the amount that the broker-dealer can loan on the sale of those securities. Reg T requirement, the amount the customer must deposit, is 50% unless you're told otherwise, thereby limiting the amount the broker-dealer can loan to the other 50%. So let's say that a client is going to buy stock in a margin account. Reg T requirement is 50%. That means the client buys $10,000 worth of stock. They've got to deposit $5,000. Again, that's called the Reg T requirement. The amount the broker-dealer can loan is the other $5,000. Reg T limits the amount the broker-dealer can loan by establishing the amount the customer must deposit. The amount the customer must deposit is known as the Reg T requirement. In our example, that was $5,000. Again, limiting the amount the broker-dealer can loan to the other $5,000 on a $10,000 trade. Now let's talk about the Investment Company Act of 1940, ICA of 1940. The Investment Company Act of 1940 defines and regulates investment companies. There are three different types of investment companies. There's the face amount certificate company. On the test, you'll probably see this as the FAC. There's the unit investment trust, UIT, and the management companies. Those are your three types of investment companies: FAC, UIT, and the management company. Now, the management companies are broken into two groups. There's the open-end management company, which is the mutual fund, and there's the closed-end management company. Investment Company Act of 1940, definitions. Affiliated persons. An affiliated person would be an officer of the investment company, a director, someone who sits on the board of directors, a partner, if it's a partnership, or employee. They somehow are involved with the investment company. Would someone who owns shares of the investment company be an affiliated person? Yes, if they own 5% or more of the outstanding shares. Also affiliated would be the investment advisor. And we're going to learn why it's important to know who the affiliated persons are, thereby learning who is not an affiliated person a bit later. Interested persons includes affiliates and immediate family members of the affiliates. So an interested person is an affiliate, such as an employee. Spouse of an employee is not an affiliate, but an interested person. The son of the employee is not an affiliate, but an interested person. Lawyer to the firm in the past 2 years, to the investment company in the past 2 years. Broker-dealer with business relationship in the past 2 years. Broker-dealer sells the investment company shares. Fund manager executes trades through the broker-dealer relationship in the past 2 years. Any person deemed interested by the SEC, also an interested person. Now, folks, I want you to commit this slide right here to memory. The information you see on this slide, I expect several questions on the exam to come from this information. Now, we're going to be comparing the open-end management company to the closed-end management company. There are 6 different characteristics that we're going to look at here. And we're going to look at each of these characteristics as it relates to the open-end company, and each of these characteristics as it relates to the closed-end company, and we're going to see the differences between the 2 types of management companies. We start with buying shares. The open-end company always sells new issue shares, continuous primary offering of new shares. How many shares can an open-end company sell? How many shares can they issue? An unlimited number of shares. And they can sell full and fractional shares. What about the closed-end company? The closed-end company is going to have a single offering of a fixed number of shares. And the closed-end company can only issue full shares, no fractional shares allowed. Trading securities. Redeem back to the fund company. I buy mutual fund shares. I decide I want to get my money out of these shares. Would I take these shares to a secondary market and sell them? No, I would not. I would redeem these shares back to the investment company. So, open-end shares do not trade in any type of secondary market. They're not listed on an exchange, such as the New York Stock Exchange. They do not trade in the OTC, the over-the-counter market. Now, what about the closed-end shares? Let's say that I buy some closed-end shares, and I decide I want to get my money out of these shares. Would I redeem these back to the management company, to the investment company? No. Closed-end shares are not redeemable. I would take these shares to a secondary market, and I would sell them to another investor. So these shares would trade on an exchange or the OTC market. What type of securities could a mutual fund offer? What type of securities could a mutual fund company sell? Common stock only. That is the only class of assets that a mutual fund company can sell, common stock. They cannot sell preferred stock. They cannot sell any type of debt instruments, such as bonds or notes. You have a client who has invested in a mutual fund that is a bond fund. Did this customer buy a portfolio of bonds from the mutual fund company? No. The only thing the mutual fund company can sell is common stock. So the customer owns common stock. Their money is invested in a portfolio of bonds, but what the customer owns, what the mutual fund company issued, is common stock. Now, the closed-end company, they can issue common stock, they could issue preferred stock, or they could issue debt. They could sell notes, they could sell bonds. Share price. The price that a client pays for the mutual fund shares is based on NAV. Now, NAV stands for net asset value. It's the NAV that's calculated, not the price the client actually pays. That's not calculated. The NAV is calculated. Now, the price the client pays is the NAV, net asset value, plus the SC, sales charge. That equals the POP, public offering price. But that public offering price is based on what price? NAV. Now, the price of closed-end shares is based on supply and demand of the closed-end shares outstanding. Now, when you buy those closed-end shares, in addition to that offering price, that ask price, the client would pay a commission. So there is no sales charge with a closed-end company. Shareholder rights. Mutual fund shareholders have the right to vote. They get to vote for the board of directors. They get to vote for changing investment objectives. They get to vote for the investment advisor. We're going to cover that a bit later. They also have the right to dividends, but be careful, only when those dividends have been declared by the BOD, Board of Directors. Now, what rights do mutual fund shareholders not have? They do not have preemptive rights. Now, what's a preemptive right? This kind of takes us back to the Series 6 material. Preemptive rights. Preemptive rights are securities that would allow an existing shareholder to maintain proportional ownership in a company if the company sells new shares, additional new shares. Well, mutual fund shareholders do not have preemptive rights. And the reason is because the mutual fund company is continuously offering new shares. There's no way for me to maintain my proportional ownership when the company is always offering new shares. What rights do closed-end shareholders have? They have voting rights. They have the right to dividends, but only when declared by the Board of Directors. They also have preemptive rights. Preemptive rights. Now, let's say that I own 3% of the shares of the closed-end company outstanding. Closed-end company is going to sell some additional new shares. With my preemptive rights, I would be able to buy 3% of those additional new shares before they're sold to the public. That's preemptive rights. The ex-dividend date. For the mutual fund, who sets it? Board of Directors. When is it? 1 business day after the record date. RD is record date. For the closed-end company, who sets it? It's set by the SRO, which is FINRA, and it's 2 business days before the record date. Folks, I said this a few moments ago, and it deserves to be repeated. Please memorize the information on this table. It'll help you with several questions on the exam. Structure and management of open-end companies. Structure and management of open-end companies. Now, where would we find the rules and regulations regarding the operation of the open-end company? Those rules and regulations would be found in the Investment Company Act of 1940. The Act of 1940 says that a mutual fund company, the open-end company, can borrow money, but the amount they can borrow is limited. Limited to what? Assets to debt ratio 3-to-1. On the test, I would expect you to see that referred to as 300%. So there must be $3 in assets for every $1 in debt. Now, when would a company typically borrow? They would typically borrow to meet redemptions. The Investment Company Act of 1940 says that a mutual fund company, the open-end company, must report to shareholders semi-annually and annually. And of those 2 reports, the annual report must be independently audited. Investment Company Act of 1940 places restrictions on the operations of mutual funds. Mutual funds may never engage in a short sale, selling securities they do not own, may never engage in margin trading, using borrowed money to buy securities, may never engage in uncovered options. This is where we would sell or write an option but not own the underlying stock. We would sell or write a call but not own the underlying stock. Now, I want you to be careful. While an uncovered option, particularly uncovered calls, are not allowed, selling a call and not owning the stock, covered calls are perfectly okay. Nothing wrong with a mutual fund selling calls on securities that it owns. May not participate in a joint trading account with, say, the broker-dealer who handles the portfolio trades. And the mutual fund company could own shares of other investment companies, but not more than 3% of other investment company shares. Restrictions on operations. Now, mentioned earlier, what do shareholders have the right to vote for. They vote for the board of directors, the BOD. They vote for the investment advisor's contract. You know, the investment advisor manages the portfolio. They work under a contract. Shareholders get to vote for that contract. They vote to change the investment objectives of the company. Maybe the board of directors establish this mutual fund as a growth fund, but shareholders could vote to change the objective to an income fund. They vote to approve and eliminate 12B1 fees, and they vote to change the nature of the business. Shareholders could vote to change from an open company to a closed, or from an open company to a face amount certificate company. They could change the nature of the business. Board of directors, their job is to set the policy for operating the fund. Person who sits on the board of directors is an affiliated person. Board members must serve a minimum term of 1 year, maximum term of 5. Board members may have no felonies or security-related misdemeanors. And at least 40% of the board members must be non-interested. These are outsiders or uninterested persons. In other words, they sit on the board and that's the only involvement they have with the company. So if 40% of the board members must be uninterested or non-interested, that means that no more than 60% of the board members could be interested. Remember earlier we saw affiliates and interested persons? Now, that's why this is important. That's why this is important. Need to understand who an affiliate is, who an interested person is, so you can understand what portion of the board they would make up. Now, let's say that a mutual fund charges a 12B1 fee. This is a fee that shareholders pay for the cost of distributing shares. If this is a 12B1 fund, then a majority of board members would be non-interested. A majority of board members would be non-interested. 51% would be non-interested. More than 50, but typically 51% would be non-interested. A minority would be interested. And remember, interested includes affiliated persons. The investment advisor, the portfolio manager, what's their job? Well, their job is to make investment decisions, and they have a contract with the investment company to perform these functions, to make these investment decisions. Now, how long is the investment advisor's contract? The first contract with an IA, with the portfolio manager, is good for 2 years. Who would vote to approve that contract? Majority vote of shares and non-interested board members. That 40%, unless it's a 12B1, and then it would be the majority. So folks, I want you to make sure you see here underlined, and it would take a vote of both of these groups to approve the first contract. And again, the first contract is good for 2 years. Now, after 2 years, what happens to this contract? After 2 years, this becomes an annually renewable contract. And who would vote to approve of this contract? Majority of vote of shares or the full board. Not an and here, but an or the full board. Now, be real careful. Be real careful. Majority vote of shares, not shareholders. Majority vote of shares, not shareholders. Let's say that I own 10,000 shares. I have 10,000 votes. You own 100 shares. You have 100 votes. Another investor owns 500 shares. They have 500 votes. There is a vote on the investment advisor's contract. You and the other shareholder who owns 500 shares, you two vote no. I vote yes. Well, from a shareholder perspective, the majority voted no. I voted yes, and I own more shares than you do. Therefore, I got more votes. So it's not shareholder votes, it's votes of shares. Be careful. Now, could the investment advisor's contract be terminated? Yes, with a maximum notice of 60 days. Not minimum, folks, maximum notice. Let's say that an investment advisor has been doing a very poor job managing a portfolio. Could their contract be terminated by the investment company? Yes. When would they terminate? What type of notice would they probably give? Like a 1-second notice. Your contract's terminated. Maximum notice, 60 days. There is no minimum notice. More than likely, the notice would be 1 second. You're terminated. Because they don't want to give, the investment company does not want to give that investment advisor whose contract's being terminated a bunch of time to manage the portfolio. They're angry, they're irritated, so they drive that portfolio into the ground. So be sure to know there's no minimum notice of termination. Maximum is 60 days. Now, the advisor is paid a fee based on the annual net assets that the advisor manages. And this is the largest expense that any mutual fund has. And we see here that the fund manager, the portfolio manager, must adhere to the fund's investment objectives. If it's a growth fund, then the manager must be investing for what? Growth. If it's an income fund, the manager must be investing for income. Now let's talk about the underwriter. The underwriter is also known as the sponsor or distributor. What's their job? Their job is to market the mutual fund shares. Now, the underwriter must be a FINRA member, and the underwriter may not inventory shares. So they could buy shares from the mutual fund company to fill a customer's order, but they could not buy shares from the mutual fund company to put into inventory, to then mark up and later sell. Now, could the underwriter buy shares as an investment? Sure, but not to inventory, which means they put in shares into buy and put them into inventory, mark them up, and later resell them. Can only be bought as investments, can only be bought to fill existing customer orders. Now, the underwriter is compensated by the sales charge. The sales charge is also known as the load. Now, the load is not an expense to the fund. The sales charge is not an expense to the fund. The sales charge is an expense to who? The customer. The maximum sales charge is 8.5%. Now, this sales charge is allowed, but only if the mutual fund allows breakpoints and rights of accumulation. You might see that as ROA. Now, breakpoints and rights of accumulation have to do with a reduction in sales charge for a quantity purchase of mutual funds. What if the mutual fund does not allow breakpoints, does not allow rights of accumulation? Then the maximum sales charge will be 6.25%. If the underwriter uses a dealer to market, the dealer must also be a member of FINRA and shares in the sales charge with the underwriter. So the underwriter could sell shares directly to the public using their own sales force, or they could sell shares to the public using a broker-dealer's sales force. If the underwriter uses a dealer to distribute shares to the public, that dealer must be a member of FINRA, and the dealer will share the sales charge with the underwriter. So the underwriter gets paid a portion of the sales charge, and the dealer gets paid a portion of the sales charge. Return to mutual fund if redeemed within 7 business days. What does that mean? Let's say that a client buys mutual fund shares from the underwriter or from the dealer. The customer redeems their shares within 7 business days of the initial purchase. This is a bad sale. Actually, it's the name, it's a rule. That's the name of it, the bad sale rule. This is a bad sale. This trade was not suitable. If this trade had been suitable, the client would have kept those shares for more than 7 business days. Because they redeem within 7 business days of the initial purchase, the sales charge is paid to the mutual fund company, not to the underwriter, not to the dealer, and please be careful, the sales charge is not returned to the investor. What would the investor get? Whatever the NAV was at time of redemption. 12B1 fees. 12B1 fees. These are asset-based fees that would be used to pay for the cost of distributing shares. So these fees are paid by shareholders, and the money is used to pay for cost of advertising, cost associated with sales literature, costs associated with paying commissions. Now, folks, are these fees in addition to a sales charge? Yes. Are these fees in addition to the other fees and expenses associated with owning mutual fund shares? Yes. Now, many times you hear the 12B1 fee referred to as a trail. Now, these fees are charged on a quarterly basis and are renewed annually. Now, who would approve the 12B1 fee to start with? That would be a majority vote of the board of directors plus shares. What if we have a 12B1 mutual fund where fees are being charged? Can these fees be terminated? Yes. How can the termination of 12B1 fees take place? Who would vote to terminate? Majority of the non-interested board of director members and the shares, majority of the shares. Now, you may be looking at this going, well, why would shares want to approve anyway? Who knows, who cares? Not on the test. You just need to know who approves, and you need to know who terminates. Who approves would be the full board plus vote of shares. Who terminates would be the non-interested board members plus shares. Now let's take a look at the maximum 12B1 fees. We see here there are 4 different share classes. There's Class A shares, Class B shares, Class C shares, and no load, which would be NL. Now, what is the maximum 12B1 fee for Class A shares? 0.25% of assets. Now, folks, you might see that as 25 basis points. What about Class B shares? Maximum 12B1 charge is 0.75% of assets, which is 75 basis points. Now remember, Class B shares will at some point convert to Class A shares. Once that conversion takes place, then the max 12B1 fee would be 0.25% of assets. Class C shares, maximum 12B1 fee, 0.75% of assets, 75 basis points. And finally, the no-load fund. No-load mutual fund has no load, has no sales charge. Could the no-load fund be assessed a 12B1 fee? Yes, 0.25% of assets, which is 25 basis points. There are your maximum 12B1 fees for the different share classes. Mutual fund sales disclosures. The disclosure we're going to look at is the omitting prospectus. This is known as the tombstone ad. The tombstone ad is an advertisement. It is not to be used for solicitation. Omitting prospectus is an advertisement. It is not to be used for solicitation. Now, the reason omitting prospectus is known as the tombstone ad is because much of the information that's in the prospectus is omitted from the ad. Much of the information in the prospectus is omitted from the ad. So the ad contains the bare bones information about the mutual fund. And what lies beneath the tombstone? bare bones. Now, if you've ever looked at a mutual fund ad in a periodical, newspaper or magazine, or if you've ever watched a mutual fund ad on TV, you'll notice the ad never asks you to buy shares. The ad will ask the investor to contact their investment professional to obtain a prospectus. It's the prospectus, also known as the statutory prospectus, that would be used to solicit for the sale of shares. Now, when does this prospectus, also known as the statutory prospectus, have to be delivered? At or before solicitation? What else could we use to solicit for the sale of shares? Summary prospectus, also known as a profile. When does it have to be delivered? At or before solicitation. Now, as the name implies, a summary prospectus is a summary of the full prospectus and can be used to solicit for the sale of shares. If we use a summary prospectus to solicit for the sale of shares, would we still have to deliver the full prospectus? Indeed, we would. When? No later than settlement date, also known as confirmation date. And the last document here is the Statement of Additional Information. On the test, you might see this as the SAI. Now, this Statement of Additional Information is only provided upon the customer's request and then must be provided within 3 days of such request. Now let's move into a variable annuity. Variable annuity. Variable annuity pays a variable rate of return, no minimum rate of return guaranteed. Now, folks, I want to be sure you're real clear here. The variable annuity, as is tested, is not the way variable annuities work in the real world. If you know anything about the annuities that PFSI offers, some of the things that I'm going to tell you here contradict what you know to be true in the real world. What I'm telling you is what you need to know in order to pass the test. So don't get caught up in the contradictions. Well, that's not how the MetLife annuity works, or the Lincoln. That's not how the Lincoln annuity works. I understand that, but what we're doing is we're covering the variable annuity as you need to know it for the exam. So don't get caught up here and get confused comparing what we're saying here to the real world. Got to leave the real world outside. Again, a variable annuity pays a variable rate of return, no minimum rate of return guaranteed. With a variable annuity, you'll receive a variable monthly check amount for life if you annuitize the contract. You'll get a check for as long as you live. You will not know the amount of each monthly check. Again, don't get what you know about the real world confused with what we're talking about here. We're telling you what you need to know in order to pass this test as it relates to the variable annuity. I was doing an annuity class several years ago. Lady in class, she stopped listening when I started talking about annuities. I know that because she picked up a newspaper and started reading. And that was okay with me. She wasn't disturbing anyone. I got an email from her a couple of weeks later. She failed her test. And what got her were variable annuities. She told me, she said, see, I didn't pay any attention to you when you talked about variable annuities because I've been in the annuities industry for 20 years. What can you tell me about annuities I don't already know? She said, but I realized I was in trouble when I saw the first question on a variable annuity because this had nothing to do with what I knew as it related to annuities about. So, folks, you got to quit worrying about what you know about in the real world and focus on this test here, okay? Now, risk. There are 3 risks associated with a variable annuity. The first risk is the market risk, also known as the investment risk. This is the risk that the rate of return will be lower than anticipated. Who assumes this market risk? The annuitant. The client does. Mortality risk. Longevity risk. Now, this is the risk that the annuitant lives too long. I annuitize my variable annuity. I'm going to get a check every month for as long as I live, even if my money runs out. I live so long that my variable annuity is depleted. There's no money left in my annuity. I'm still going to get a check every month from the insurance company. My money's gone. Whose money am I getting? Insurance company's money. So who runs the mortality risk? Who runs the longevity risk, the risk that the annuitant lives too long? Insurance company. Now, there are expenses associated with owning a variable annuity. Insurance company guarantees that these expenses will never go above a certain level. What if actual expenses go higher than the guaranteed maximum? Who has to eat those actual expenses? The insurance company. That's the expense risk assumed by the insurance company. Now, the reason a client is going to purchase a variable annuity and assume that market risk is they're hoping that the rate of return that they earn will at least keep pace with inflation. So people buy variable annuities as a possible hedge against inflation. No guaranteed rate of return, no guarantee that the return will indeed keep pace with inflation, possible hedge. Separate account. Separate account is classified by the Investment Company Act, the ICO of 1940, as an investment company. And the separate account has various sub-accounts within it. Each has a different investment objective. So we have the separate account, which is the investment account, and within the separate account are the various different sub-accounts that a client chooses from. Each of those sub-accounts has a different investment objective. Variable annuity phases. There are two phases to a variable annuity. There's the accumulation phase, known as the pay-in phase, and there's the annuity phase, known as the payout phase. Now, the accumulation phase is when I'm putting money into the contract. I'm putting money in maybe on some type of schedule basis, maybe every month or every 6 months. The annuity phase is when I start taking a monthly check out of the annuity, and I'll get that check for as long as I live. Now, during the accumulation phase, what represents my ownership of this annuity? Accumulation units. During the annuity phase, what represents my ownership of this annuity? Annuity units. Accumulation units. The number of accumulation units increases as I put more and more money into the annuity. Now, let's say that I have bought a deferred annuity and I'm making periodic premium payments into that annuity. As I put money into the contract, I buy more units, so the number of units increases. Can I stop putting money into that contract? Sure. Would the contract lapse? No. Not like an insurance policy, but the number of units would no longer increase. The number of units would now be fixed. The value of these units increase if the separate account earns money. Any growth causes the value to increase. The value of the units would decrease if the separate account loses money, and the unit value is calculated daily. Now, folks, they're never going to ask you to actually calculate the value of a unit, but they will expect you to know, given a particular rate of return in the separate account, in the investment account, if the annuity unit value goes up or goes down. Annuity units. The number of annuity units is fixed. The value of these units increases if the separate account earns more than the assumed interest rate. On the test, that will be the AIR. The value of the units stay the same if the separate account earns the same as AIR. And the value of units will decrease if the separate account earns less than AIR or loses money. Now, no redemption once annuitized, which simply means when I annuitize my contract, the only way I can get money out of this contract is monthly payments. Please note, The AIR is not a guaranteed rate of return, but is a benchmark. It is an expected rate of return. What's the guaranteed rate of return for a variable annuity? There is not one. The AIR is not a guaranteed rate of return. It's an expected rate of return. It's a benchmark. It's a benchmark. Now, let's take a look at some examples of what we're talking about here. Let's say that we have a separate account who earns an annualized rate of return of 6%, and the AIR is 4%. 6% rate of return, accumulation unit value goes up. Remember, the accumulation unit value goes up if we earn money, any amount of money. What would a 6% rate of return do to the annuity unit value? Well, I mentioned that the AIR is 4%. 6% rate of return is more than AIR, more than expected. Therefore, the annuity unit value would go up. What if instead the separate account earned an annualized rate of return of 5%? What happens to the accumulation unit value? It goes up. Any growth causes the accumulation unit value to rise. What about the annuity unit value? Well, 5% is more than AIR, so the annuity unit value would go up as well. What if the separate account earns an annualized rate of return of 4%? What happens to the accumulation unit value? Any growth, the accumulation unit value goes up. What about the annuity unit value? Well, 4% rate of return is the same as expected, same as AIR. Therefore, the annuity unit value stays the same. What if instead the separate account earns an annualized rate of return of 2%? What happens to the accumulation unit value? Well, any growth, accumulation unit value will go up. What about the annuity unit value? Well, 2% is still a positive rate of return, but that rate of return is lower than expected, is lower than the AIR. Therefore, the annuity unit value will fall. What if a separate account instead earns an annual rate of return of -1%, 1% loss? What happens to the accumulation unit value? Now that value goes down. What about the annuity unit value? Well, that's less than expected. That value goes down as well. You have two clients investing in a variable annuity. One client is in the accumulation phase. The other client is in the annuity phase. The separate account earns an annualized rate of return of 2%, and the AIR is 4%. What happens to your client's accumulation unit value? Any growth would cause the accumulation unit value to go up. What about the annuity unit value? Well, 2% is a positive rate of return, but it's lower than expected, lower than the AIR of 4%. Therefore, the annuity unit value will fall. So you have two clients investing in a variable annuity, each in different phases, both experiencing the same rate of return, but getting different results, and that's because they're in different phases. In one phase, there's a benchmark. In one phase, there's not. What phase has the benchmark requirement? The annuity phase. What phase does not have a benchmark requirement? The accumulation phase. Now let's take a look at the monthly retirement check. Payout. Client has annuitized their contract. They're going to get a check every month for as long as they live. Now, there are several factors that are going to affect the amount of the monthly check. What would those factors be? First, valuation of the contract at time of annuitization. The more valuable the account is when it's annuitized, the larger the check. Age at which you annuitize. The younger you are when you annuitize, the smaller the monthly check. The older you are, the larger the monthly check. Larger the monthly check. Let's say that I started a little internet company when I was in college. When I turned 30, I sold that little internet company for $35 million in cash. I used that money to buy a variable annuity, and I'm going to annuitize the contract today and start getting a check when I'm 30 years old. By the way, can I do that? Sure. There's no age limit on annuitization. Let's say that we have another annuitant who annuitizes a contract same value when they're 60 years old. Which of those annuitants will get a larger monthly check? The 60-year-old. And the reason is simple. When you annuitize, insurance company is going to pay the check out for life. Statistically, who's going to live longer? The 30-year-old. Therefore, the insurance company wants to hold a lot of principal back because they know they'll have to pay a check out over a longer period of time. What about gender? Who's expected to live longer, men or women? Women are. So women would get a smaller monthly check because statistically the insurance company knows they're going to have to pay out the check over a longer period of time. Settlement option that you choose is going to affect your monthly check. And finally, the rate of return in the separate account compared to the AIR. If the rate of return is greater than AIR, next month's check goes up. If the rate of return is less than AIR, next month's check goes down. If the rate of return in the separate account is the same as AIR, next month's check stays the same. And there is an illustration of what we're talking about. Now let's take a look at how the rate of return compared to the AIR is going to affect the check amount. We have a client who has annuitized their contract. The AIR is 4%. In January, the separate account earns an annualized rate of return of 6%. The client receives a $600 check for the month. Now, 6% is more than AIR, therefore the check in February will go up. February, the rate of return earned is 5%. 5% is more than AIR, therefore the March check will go up. Now, folks, I don't care that 5% in February is less than 6% in January. All I care is 5% in February is more than AIR. If that's the case, next month's check goes up. March check goes up. March earns an annualized rate of return of 4%. Now, that's the same as AIR. What happens to the next month's check? Next month's check is April. It's the same as March. April earns 2%, less than AIR. That means the next month's check, May, will be less than April. May earns 3%, less than AIR. Therefore, the next month's check, June, will be less than May. June earns 5%, more than AIR, so the next month's check, July, will be more than June. And there is an example of how the rate of return compared to AIR affects the check amount. Now, folks, they're never going to ask you to calculate a check amount. They will expect you to know what happens to the check amount, up, down, or stay the same. Question might be something like this. You have a client who has annuitized their contract. The AIR is 4%. The separate account rate of return for January is 6%. For February is 5%. For March is 4%. What happens to the April check? Well, 4% is the same as AIR. Therefore, the April check will be the same as March. So if they're asking about the April check, all I want to know is what was the March's rate of return compared to AIR? I don't care what happened in January. I don't care what happened in February. Why was January and February even there? To confuse you. To confuse you. I don't care what the rates of return in January and February were. What if they ask you what happens to the July check compared to June? What rate of return do you want to know? What was the June's rate of return compared to AIR? That tells you what happened to the July check. So you only go back 1 month. taxation. Now, unless you're told otherwise, variable annuities are non-qualified, which means they're funded with after-tax dollars. So our deposits, the money we put in the annuity, is our cost basis. That's money we pay tax on. Money grows tax deferred. We don't pay tax on the earnings until the money is removed. Now, at time of distribution, when the money is removed, then those earnings would be taxed as ordinary income, never capital gains, ordinary income. And if you take the money out before 59 and a half, there also may be a 10% tax penalty. Let's take a look at taxation relating to taking money out during the accumulation phase. Can we take money out during the accumulation phase? Sure. We can take a check out of our annuity during the accumulation phase, and we can continue to do that until there's no money left. So if you take money out during the accumulation phase, you will not get a check for life. Let's take a look at some examples here. First, let's look at a lump sum withdrawal. I put $10,000 into my variable annuity. That's money I paid tax on. That's my cost basis. The value of the account grows to $15,000. That's $5,000 of earnings. I do a lump sum withdrawal. I take out $15,000. $5,000 of that withdrawal is taxed as ordinary income. And if I do this withdrawal before 59 and a half, there'll also be a 10% tax penalty on the earnings, not on the cost basis. Now let's take a look at a random withdrawal. I put $10,000 into the variable annuity. That's my cost basis. Value grows to $15,000. That's $5,000 of earnings. Now I do a random withdrawal of $8,000. What is the accounting method used? LIFO, last in, first out. As far as the IRS is concerned, the last thing that went in was the earnings. So the first thing that comes out will be the earnings. So $5,000 would be taxed as ordinary income. And if I did this withdrawal before 59 and a half, there would also be a 10% tax penalty on the $5,000. Now this was an $8,000 withdrawal. $5,000 we've accounted for. $3,000 has not been accounted for. The $3,000 would be return of cost basis. I've already paid tax on this money. Therefore, no tax would be due at time of withdrawal, and also there would be no tax penalty on this $3,000 at time of withdrawal either. Death benefit. Variable annuity has a death benefit. Now, this death benefit only exists during the accumulation phase. Once you annuitize the contract, the death benefit goes away. Now, the death benefit is either cost basis, money you put into the contract, or value of the contract at time of death, whichever is greater. Taxable as ordinary income to beneficiary in excess of basis. So the death benefit would be paid to a beneficiary, and any earnings would be taxed to the beneficiary. The value of the death benefit would be included in the value of the deceased estate. And again, the death benefit is lost when you annuitize the contract. Let's look at an example of this. Let's say that I put $10,000 into my variable annuity. That's my cost basis. The account grows in value to $15,000 and I die. The death benefit is cost basis or value, whichever is greater. So the death benefit is the value, $15,000. Now, of that death benefit, $5,000 would be earnings. Those earnings are taxed to the beneficiary as ordinary income. No tax penalty, but the earnings would be taxed as ordinary income to the beneficiary. The value of the death benefit, $15,000, would be added to the value of the deceased estate. Now, what if instead I put $10,000 into my variable annuity? That's my cost basis. When I die, the contract is valued at $9,000. I've lost money. Contract is valued at $9,000. What's the death benefit? Well, it's either cost basis or value, whichever is greater. The cost basis would be greater, so the death benefit would be $10,000. Now, taxes have already been paid on that $10,000. No earnings, therefore the beneficiary has no tax liability. That $10,000 death benefit would be added to the value of the deceased estate, and there might be estate taxes due on that death benefit value. Now let's talk about taxation during the annuity phase. I've annuitized the contract. I'm going to get a check every month for as long as I live. Part of each monthly check will be return of cost basis, which is not taxed. That's determined by the exclusion ratio. And part of each monthly check would be payment of earnings, which would be taxed as ordinary income. Now, folks, we want to make sure you're real clear here. When you annuitize the contract and start taking money out monthly, no matter what age, there is no tax penalty. There is no tax penalty. So if you annuitize your contract at 40 years of age, there would be no 10% tax penalty when you annuitize. Now, let's pick that exclusion ratio up again. Exclusion ratio is a formula that the insurance company uses to determine how much of each annuitant's monthly check is excluded from taxes. And what portion of the monthly check is excluded from taxes? Cost basis. Therefore, the exclusion ratio is used to determine how much of each monthly check would be cost basis. The rest of the monthly check would be payment of earnings, and those earnings would be taxed as ordinary income. Now let's talk about training and education. We're going to have to go through continuing education with our registration. There are two elements to continuing education. Probably see this referred to as CE on the test. There's the regulatory element, and there's the firm element. Now, regulatory element. All registered persons must complete regulatory element CE. This must be completed within 120 days of the second anniversary date, and thereafter it would be every 3 years. Now, firm element CE. Only registered people dealing with the public are required to complete firm element CE. This is an annual type of training, and recordings are allowed. Annual compliance meeting, ACM. All registered persons must complete the ACM. This is done annually. Now, the ACM must be interactive. Recordings are okay as long as questions and answers have been recorded. Now, folks, that's the end of Chapter 2. There are 19 questions on the exam covering Chapter 2.